So risk and exposure within market cycles. All right. So for those of you that have been paying attention, this is, I'm going to just click through to the end because I find this a lot easier to read when we get it all here. So if you think about 2021, there was optimism, excitement, thrill, euphoria, and then it started to go down to anxiety, denial, fear, desperation, panic, capitulation. All right. Maybe I should get out of this. Maybe I should do it. Despondency, depression. Okay. And then now we're starting to get into hope, relief, and optimism. I don't know how many people on here think that 2025 is going to be an amazing year, but I do believe that we are reaching this thing where we are starting to ramp up, right? And so if you look at here, all of the different things that have happened, all of the different factors, right? So this is on the risk reward pendulum. A lot of things are happening. And how many people have seen this happen, right? It got really going. Everybody thought in 2020 things were, kind of at the gonna fall apart, but it kept going crazy. And then it came down and it stayed in here right through to the end of 23 into the beginning, almost the end of 24. And we believe that we're in a period of hope, that we're going to have some relief, and we'll actually reach into the realm of optimism. And that's our story, and we think that that's going to happen, and we're very excited about it because it's going to create a new thing, new possibilities for us. So again, if you talk all about the phases of real estate cycle, so there's pricing dislocation, value normalization, asset base explanation, value at the peak, and all of the different things that go into here, right? So you get all of these things that happen, and we think we are here today. So we believe strongly that we're here today, that things are going to start to change, right? Right now, we still have a lot of things happening, right? So we have things that are doing performance rebounds. We have listed access to or capital on the balance sheet strength, all of the different things. And then we think that we're going to reach into here where we're going to get power from limited supply and benefit. We're going to get debt maturity and increased acquisitions. There's a lot of loans that are going to be coming due. And then we think that we're going to get into this value here where we're going to start to be able to really focus in, to really be able to grow our assets and take things to the next level. So this slide is shown for a couple of weeks now, but I wanted to re-show it that, these are all the different markets. So 23, 24, 25, and you see in the US, it was still pretty 2.5 growth, 2.4 growth, and then 1.1 growth, right? So the median growth, but United States is in this little dip of growth, year over year change. And again, we think that we're going to be starting here in 25, we're going to start being able to come out and get to the next level. So for some on the commercial real estate, the shift to prospective rate cuts has boosted sentiment for the remainder of 24 and 25. That said, a single rate cut, we just actually had our third rate cut today. It's going to have some limited effects. It's going to take time for it to come through to the marketplace. All right. This is a wild chart, right? So these are all of the different things, So North America, if you look at some of the charts, there's a lot happening in all of these things. But you see here, multifamily is super, super strong in this space here. There's a lot of things going on. This is a mind-boggling chart, but it's super important to know that multifamily in North America is on the top sectors. If we come down to the second center, it is the logistics and warehousing. And then if you come through to here, it's industrial and manufacturing, a little hard to follow, digital economy, hotels, and then we have different things with the malls and different things that are happening. So it's a pretty impressive chart. So multifamily, business park logistics, industrial, and neighborhood retail are the top areas that we believe for 2025 will be the areas for people to focus in. All right, the rate cuts. Who watched the news today? Saw that it went down another 1/4%. Do you think that's good news or bad news? Put it in the chat. Good news, bad news. But you know what's interesting? I was shocked. The stock market went way down. They announced the rate cut and the stock market, even cryptocurrency went down. That was a big surprise to me. I'm not sure if I can really figure out why that happened. I think it's just a reaction that the market had already built it into being there. But it's super good. And we believe that there'll be 2 to 3 more rate cuts next year. So we're super excited about next year coming up. And again, inflation is very sticky. We're very excited that we have a pro-business government coming. They're going to put some money into the economy, which will create more purchasing power, and they're going to cut some government jobs, which is going to lower GDP, and that will slow down the economy. So it's a little bit of mix of a couple of things that are happening. Top cities. Who would take a guess? What's the top city? I was absolutely shocked. Boston, Massachusetts. I was just on a phone with Pavel earlier today. Who would think that? Look at there. Charlotte, North Carolina, Grand Rapids, Michigan, South Carolina, Connecticut again, Indiana, Kansas City, Knoxville, Tennessee, Arizona, and then San Antonio. That's pretty interesting that these are for housing, mind you, but housing, a lot of things flow along with the housing market and the different things that happen. All right, I got some good news. Tomorrow night, we've got some amazing webinars happening. So we have 2 different webinars happening. We have one for Candela, our lifestyle retail development, and we have another one for Horizon Apartments. I went through this presentation pretty fast. We're going to be like having lots of networking time. So we're going to talk a little bit about the difference between the two. So if you want to look at the Horizon deal, that is a 5-year hold with a 50K minimum. We're talking about a 18 to 19% IRR, a 2.1 multiple, 7% preferred, and a 70-30 GP split. So we'll give a little bit more information, see what you're going to do here. And then we have another one, which is our new build retail. If you remember, the new build retail is one of the hot markets. And also remember, San Antonio was on this particular chart here. Let me go back there. San Antonio right down there. So a great growing market. We have our new retail development, 21% internal rate of return. This one has a 75K minimum, a 1.6 multiple in 3 years, 7% preferred return. And then we have a waterfall. Waterfall is an interesting split. So if we do not produce our goal of 21%, actually anything less than 17, it goes to a 70-30 split. And then when we do reach that, it goes to a 50-50 split. So I want to talk a little bit about the difference of the types of returns that happen. And also maybe if you could put in the chat, Maria or Jasmine, the link for people to sign up. So this particular one for Horizon is at 7 o'clock tomorrow night Central, and we'll put in a link in here. And I want to explain a little bit about the difference of these types of investments because it's very important, right? So we've already kind of talked high level of what we're going to do. This is a really nice way to see on a lower level. So in year 1, we're going to get about 5% cash on cash. Year 2, about 7.5. Year 3, about 8.5. So I want to make sure that we remember this has a 7% preferred return. So until we catch up to year 3 and you've got accumulated returns of 7%, us as the general partners aren't making any profits. We're not getting any of the distribution. There is no 70-30 split. So we're super motivated to be able to get there. And then in year 4 and year 5, as the property builds up, as we get a little closer to sale, going to definitely generate some more cash flow. So I want to give you an idea how this works. So if you put in $100,000 during the 5 years, you're going to get about a 40% total return on cash flow. Then when we sell the property, you're going to get about a $71,000 return. So if you put in $100,000 at the end of the 5 years, you would have made just under $40,000 through cash flow, just over $70,000 on proceeds from the sale. And again, these are all projections. These are all based on what we believe are going to return. And again, remember, we're highly motivated, right? Because we don't get paid till you at least get accumulated 7% return. And then afterwards, it's 70 cents of every dollar goes to our investors, and 30 cents of every dollar would get split between us as general partners. So again, it's a very, very important way to look at it. Another thing that's super exciting about this project, bonus depreciation. So I'm not sure how many people, I think most of the folks, I can kind of read through the names, you have a pretty good idea what bonus depreciation is going to do to you. You know, a lot of people are saying, well, maybe when Trump comes in, he's going to, he's not going to. Nobody knows what you're going to do. And so bonus depreciation, the beautiful thing about it is, if you put in $100,000 into this particular opportunity, you will get a passive loss this year of about $38,500. It's a pretty amazing way for you to be able to get it back. Now, if you are a full-time real estate investor, this whole thing will go on your taxes and it will cover it. If you have a W-2 job and you are only able to use it against your passive income, don't worry, because it's not a use it or lose it situation. It's a situation where it stays there until you use it. So you can continue to use it. So if you remember, as we start generating some of these payments, well, you already have some bonus depreciation to cover the payments and do the different things. And then, of course, if you've been able to use it and leverage it, you're going to be able to reduce your taxable income. Remember, it's not how much you make, it's how much you keep. And then over the balance of the period, you'll get about another 33,500. So that will come in year 2, 3, 4, and in year 5. Yes, there is recapture when it comes back. But again, if you can efficiently use this, you should make it to where you're in a very variable, very, very tax favorable position. So then our next opportunities we mentioned before, and Maria, if you can pop in the link, that one is tomorrow at 6 o'clock, and it is called Candela, and it is a new build retail. Again, remember the top 4 things, it was number 4, neighborhood retail. There's a huge difference between shopping malls, strip centers, and what we're referring to as neighborhood retail. The biggest difference is it's a destination place. So I hope everybody can come tomorrow, come to the webinar and learn a little bit. So this one is very different. And I wanted to put these slides up so that you could get an understanding of the difference. This one's about a 21% IRR. We do have a higher minimum, but talk with us. We can make sure that we can get you into the deal. By the way, both of these deals were for accredited investors. I should have mentioned that at the beginning. And if you're not accredited, you can still come to the webinar. You can still learn. You can still ask some questions. You just won't be able to invest. It also has a 7% preferred return. And as I mentioned earlier, it has this unique thing where it has a waterfall. So if we don't pass 17% IRR, it's a 70-30 split. But if we do our plan, what we think we're going to do, it turns into a 50-50 split. So again, I want to make sure that you understand this. You get the first 7% accumulated before you get any returns. So if this project does not go well, you get paid first, any money until you've made at least 7% on your money. Then if we can't do more than a 17% IRR, and again, the thing that's going to change the IRR is the 3 years. If this thing ends up taking 4 years, that's what would impact the IRR. So it's a huge motivation for the sponsorship team to get this project built, leased, and then sold so that we can get into the 50-50 split. And again, I want to make sure that I'm clear. All of these numbers that we've told you on the projections, they're based on us achieving this goal. But different than the Horizon, there is no bonus depreciation on this because it's a new build. There's nothing to depreciate. So one thing I always like to tell people, if you have retirement funds or cash, always invest the cash, if at all possible, into a deal where you're going to get some bonus depreciation, and always invest the retirement funds into something where it's not there. And again, this doesn't mean that, oh, you shouldn't put retirement funds into Horizon or you shouldn't put cash into Candela. It's purely if you want to be the most efficient with your money, because again, you want to invest where you feel comfortable, where you want to make sure that you do it. I'm just doing this. And again, this particular deal is very different. There is no cash flow. So we're building it during the first year, we're leasing it during the second year, and then we're getting everything finalized in the third year. And the goal is to sell it, and you'll make just a little over $60,000. So we'll return $160,000 again on a projection, which is the 1.6 multiple in 6 years. So a lot of people go, well, I'm used to doubling my money 2 years. If you actually kind of calculate this out, 1.6 in 3 years is really like 2 point whatever in 5 years. It's a big difference on the delta.